Welcome back to Margin of Stupidity. I'm Abhishek and today I'm going to upset some of you guys. If your portfolio is full of SME stocks and you have made a lot of money in the last few years, then this podcast is going to upset you a little. In the last few months, I've spoken to many investors who have pitched SME stock ideas. So a lot of these ideas have very strong promise of becoming 10 times, 100 times in the next few years. But let me tell you, for every one stock of SME that becomes a 100 bagger or 10 bagger, there are dozens that get wiped out. And that is what we are going to talk about in today's episode. And I totally agree to the point that when an entrepreneur becomes 1 from 0 or 100 from 1, if you are with him or her in part of their journey of growth, you tend to make a lot of money. Not because the stock prices went up, but because that entrepreneur delivered something exceptional over the years. And hats off to entrepreneurs who deliver that. However, we have to take a step back and understand the base rate. What usually happens is a lot of these SMEs, a lot of these small businesses remain small. Doing business is difficult. Business failure rate itself is around 90%, more than 90%. SMEs are part of that pie. So the probability of them failing is higher when they are small. But as the business becomes bigger, the probability of survival and growth increases. The point that I'm trying to bring is only because it is listed does not mean it is investable. There are a lot of businesses which can be listed on the stock exchange, but they are not worth investing for a retail investor. Now, there could be multiple reasons that we will get to. For now, you have to understand that a listed company, whether it is an SME or a small cap, can become mid or large cap over the years if they continue to deliver sales and profit growth. The probability of them delisting, getting out of the exchange, or wiping out your complete capital is also very high. And that is not suitable for most investors. So if you look at the probability, what is the chance of an SME that you have invested in becoming a multi-bagger or becoming a large cap company? There are not many companies that can continue to scale unabated for a long period of time and achieve that kind of scale. Yes, that does happen, but it does not mean that every SME will see that fate. So the default assumption should be this SME will remain small. There is a possibility, maybe 5% or 2%, that this will become big. And accordingly, we have to invest. When we are getting into something like this, we have to keep this in mind. I was countered a question that if I build a portfolio of such SME companies, maybe 20 stocks, my odds will increase. And I said, yes, your odds will increase. But let me tell you that unless you have the right stock picking skills, that along with the market giving you that kind of valuation and these companies delivering that promise, so there are multiple factors at play and all these should come together for this portfolio to deliver you return. So to give you an example, consider a Golgappa venture, right? So a Golgappa vendor can invest maybe a couple of lakh rupees and start earning 50,000 rupees a month in net profit. It's a possibility. A lot of people do that. So that's essentially around 6 lakh rupees earnings on an investment of 2 lakh rupees of capital or the equipment, etc. Now we think, oh wow, that's a great business model. Now it's a great business model in itself, but it has its limitation. So let's say let's say that we want to expand this. We say that we have done exceedingly well and now we should expand this pan-India. What do you think will happen? The moment you think about scaling this to a 100 shop company, the moment you enter in 5 cities, you will see that next to your Golgappa venture, there are 5 more competitors who are there are 5 more competitors who are trying to take your profits. And that is the problem of scaling a small business. I'm not against entrepreneurs. I'm just saying this is the market reality. A small business goes through a small business goes through many difficulties to achieve a certain scale, and beyond that scale is where these companies could become worth looking at from an investment point of view for a retail investor or a small investor. Not every SME business is like a Golgappa venture. There are a lot of value adding companies, a lot of value adding entrepreneurs. However, this scale challenge remains. The scale challenge remains in the market. Scaling a venture from 1 crore profit to 10 crore of profit requires a very different skills when you scale from a 10 crore to 100 crore profit company. So up to 10 crores, an entrepreneur can hustle, can do heavy lifting, can work 16 hours a day, build all the processes himself or herself. If their employees are not contributing much, they themselves can, with the help of maybe some friends or family members, they can scale the venture up to a certain level. However, beyond a certain profit threshold, let's say 10, 20 crores, you need systems in place. You need a very strong team. You need very strong processes that can be scaled alongside, so that profit or entrepreneurs that profit or sales growth can continue to make this a bigger venture. So when I hear the stories that this particular company was SME and it became a mid cap, and the investors who stayed put made 100 bagger return or 200 bagger or 100 bagger return or 1,000 bagger return, I say yes, absolutely yes, and they were either skillful or lucky or both. However, please understand that for every such success story, there are many failure stories that get hidden. And most of the SME entrepreneurs find it difficult to scale their business beyond a point, because when you are an SME, when you are a small business, you are not in the radar of the large competitors or the large companies, because maybe you are operating in a small market. The reason a Reliance would not try and come for a Golgappa company is this: it's a very small market, although it might give you very excellent returns for the entrepreneur, but it's a small market and large competitors would not want to come at that market. To put it very shortly, SME companies or small companies tend to SME companies or small companies tend to trade at discount to their larger peer set, and the reasons for this are: one, the quality of governance. Small companies, see, before we get there, let's take a step back and try and understand. For a small retail investor, an individual investor, you are placing faith in a company, that this company will grow and the promoters will share their and I will get the benefit of the profit growth through dividends or through buybacks or through the share price increase. So the fundamental aspect or fundamental driver of a stock delivering returns is a well-governed company. Because they are small, they might not have a board to govern the practices of the promoters. Without a proper board in place, institutional investors or large investors might not look at the stock, or might not look at investing in the stock. When investing in an SME, you need to know the promoter in and out, which is not possible for most of the retail and individual investors. Because there is no board present, the institutions do not participate in such companies, and without the with the lack of institutional interest, what happens is such companies tend to have discount. But these discounts happen only when the market is functioning properly. There are times when market is euphoric, when especially during bull runs, and you will see there is a large rush of SME IPOs. So we don't really know the intention of the promoter who is looking to sell their stake. Most times, and specifically in the recent bull run, what we saw is most of the promoters were looking to cash out. They know that their business cannot scale beyond a certain point where they have taken it to, and now they know that this valuation is something that they might not get over the next 5, 10, 15 years. So it's better to cash out, and they might continue to grow the business, they might continue to run the business, but valuation becomes a very strong headwind that you might not be able to get the same kind of valuation that you got in the last couple of years. So in lack of continued bull run, you will see prices of such SMEs continue to correct as the promoters continue to sell their stake, and even the smaller retail shareholders who have limited patience, they also are not able to generate returns. They also try and exit as they find one. During such times, the prices can correct drastically when there are no takers for such stocks. Another important point is many of these SMEs report very strong sales and profit growth, but when you look at the balance sheet and their cash flow accounts very closely, you'll see that these profits are not converting to cash. A lot of their capital is still tied in their working capital. So just to give you an example, suppose you are a small company who is competing against a large competitor, and you have a client that you think you can win. The easiest way to win that client would be to go and tell them that I will provide you the same service that my bigger competitor is offering, but I will give you a credit period of 6 months. In the moment you offer that credit period of 6 months, your likeliness to win the business becomes very high, because most businesses work on credit. So you have relaxed the credit terms, that gives you a very large order. That large order gets shown in your sales, in your profit and loss account, and might be profitable as well. But when you look at the conversion of cash, your capital is still tied in the working capital. You are not able to convert that into cash. The point is the liquidity trap. Since these stocks are thinly traded, by thinly traded I mean there is no large institutional participation, you might think that the value of a particular business is, let's say, 100 and it's currently trading at 60. But since these prices are reflected in the market, the stock is trading every day, and it is and the stock is trading every day, and a lot depends on the market's mood. These prices tend to correct very sharply during the market downturns. So even though the actual valuation of the company could be 100, but nothing is stopping the stock to go from 60 to 20. And at that point of time, you will lose your conviction. You will not be able to take an exit because there is not so much liquidity. There's not so much. There are not many investors who are looking to buy your company. The third point is there is no power law at play in most of the SME companies. An analyst suggested me that SME investing is like angel investing, and I said no, not really. SME investing has a basic feature where these companies are actually trying to become more profitable. Once they are listed on an exchange, the retail shareholders and all the shareholders demand the company to generate cash flows and real profits, not only sales growth. These companies cannot continue to run in losses for a long period of time. That is point number one. That does not happen in the startup world or where angel investing is prevalent. An angel investor would take 50 bets, would expect around 70% failure rate, maybe return of capital on around 20% of those bets, and then would expect at least 1 or 2 unicorns. And that is where they make those 1,000 bagger kind of returns. And that 1,000 bagger takes care of all the losses across other companies. However, one thing is very crucial here, that when angel investor is participating or playing in a market which is private, and private market functions very differently than a public market. In private market, and with startups can deliver scale. There are investors who come into play once a VC round happens at Series A, Series B. Then the startup's valuation gets higher. I mean, that is what we have observed in the last 10-15 years, at least in India. There can be down rounds, but the possibility of that startup to get higher valuation if they stay right on the metrics. And those metrics could only be about sales. The startup can continue to make loss and yet they'll get higher valuation. In public markets, investors will run out of patience for that journey to complete itself. So when you are buying 20, so when you are building a 20 stock SME, 20 SME stock portfolio, you're not actually trying. So you're not actually getting the benefit of power law. These SME companies are most likely to give you an incremental kind of returns or incremental kind of profit and sales growth. Another point is, with these 20 companies, the risk of governance, the risk of liquidity, and the risk of seeing the ticker price every day moving up or down remains there. And if the market is not your friend, if the market mood is not in your favor, then you're likely to get hammered very soon.